Hey guys, what's up? I'm Erin and welcome back to the channel. There's a growing gap between the retirement account balances and investment account balances for high income earners and that of middle income earners. Over the past few years, the retirement account balances for these high income earners has grown far more than it has for middle income earners. According to the US Government Accountability Office, the median account balances for high income earners is $605,000. And the median account balances for those middle income earners sits at just $64,300. Compare that to the 2007 numbers where the median account balances for high income earners sat at $333,000 and the median account balance for middle income earners sat at $86,800. Over this period of time, the account balances for high income earners almost doubled and the account balances for middle income earners actually declined. Middle income earners are those earning about $52,000 to $156,000 a year. And high income earners are those earning in excess of $156,000 a year. Now, it probably comes as no surprise that having a higher income is associated with saving and investing a higher dollar amount, but it's also associated with saving a higher percentage of your income. For high income earners, on average, they're putting away 8% of their pay towards retirement. And middle income earners, they're putting away about 5%. What I find really interesting is that neither group, even the high income earners, are where traditionally financial professionals recommend people be, in that they're not saving that 15 to 20% of their income. But if you have a bigger income that you're working with, traditionally it's going to be easier to save and invest more. That's not to say you're guaranteed to save and invest more if you have a bigger income, or that you can't be a super saver on a modest income. A lot of it's going to come down to the individual person and their money habits. However, safe to say, generally speaking, if you have a bigger income that you're working with, it's going to be easier to allocate more towards savings and investing and building up your net worth. And there really is truth to that saying that money makes money. Think about it this way. If you have $1,000 invested and the market returns 8% that year, it means you made $80. But if you have $100,000 invested and the market returns 8%, now you've made $8,000. While $8,000 isn't enough to live off of, it does show why having more money invested and more money working for you makes a difference. Let's say you have $1 million invested and the market returns 8%. Well, now you just made $80,000. That very well could be more than enough to live on depending on your situation. And this is the beauty of compound interest. You put your money to work, making money with the goal of building up a nest egg large enough to support you so that one day you don't have to work. It's also the reason why it's easier to generate more wealth once you have some wealth. What I found really interesting about this study of high income and middle income individuals and looking at their retirement account balances is that they also took the time to look at factors that contributed to these balances outside of income. And what they found was that there were quite a few lifestyle factors that made it easier to build wealth regardless of income. Sticking with a career was strongly associated with higher account balances. In fact, those that stuck with a job for at least 10 years had 37% higher account balances. Now, after a year or so of headlines telling us that we can significantly increase our pay by changing jobs, perhaps this seems a little counterintuitive, but I actually think both of these things can be true. I think it's important to stick with a career, to build up your value and your skill set as an employee. But I also think it's possible to hit an earnings ceiling with one company. This could be because a company has limited resources or limited growth opportunities, or because they've simply pegged your value in line with your starting pay. So I do think over time, there is a way to strategically switch companies to significantly increase your pay. But I think too much job hopping and trying to change careers every few years is actually more detrimental to your earning potential. So I think you have to find this happy medium between building a career and strategically switching companies so that you can experience the greatest growth, both in career possibilities, but also earning potential. And part of the reason that career longevity plays a role in higher account balances comes down to periods of unemployment. It was true for high income earners as well as middle income earners that when they went through a period of unemployment that they halted contributions to their investment accounts. And it was often the case that many of their retirement account balances actually saw a decline in value during this time. But notably, lower and middle income earners experienced longer stretches of unemployment and more frequent stretches of unemployment than high income earners. And the more often you have to pause your contributions to investments, or the longer you go without contributing to your investments, that's absolutely going to have an impact on your account balances. And it's very likely that we're all going to go through phases where we have to halt contributions to our investments. There's just times in life where that budget runs tighter. Maybe it's because of unemployment, or maybe it's because of a medical event, or maybe it's just a change in family dynamics. You can still succeed with your finances and pause your investments occasionally throughout your life. But the shorter we can keep these pauses, the easier it's going to be to build wealth. Another important reason higher income earners had higher account balances came down to the fact that they were more likely to work in a job that offered a retirement option. It's human behavior to take the easy route. If your employer doesn't offer a retirement plan, most people simply just don't save for retirement. Consider that roughly only 15% of US households contribute to a Roth or a traditional IRA in any given year. These accounts are incredibly easy to set up. It probably takes all of 10 minutes, maybe less, can be done 100% online, but when left to our own devices, most people simply don't take the steps to do it. Even when a workplace employer does offer a retirement plan, we still see that human nature gets in the way. According to a Vanguard study, the average participation rate in 401k plans with automatic enrollment is 91%. Compared to only 28% in 401k plans with voluntary enrollment. So simply working for a company that has an auto-enroll feature drastically increases your odds of saving for retirement. But when you know better, you can do better. And since you know you should be saving for retirement, you can take the steps to do so. For those families where the head of household had a college degree, retirement account balances were 63% higher than where the head of household had never attended any college. And this comes down to the fact that a college degree absolutely opens doors and leads to more skilled and higher paying positions. I am a huge proponent of college education, but I don't like the idea of just getting a degree for the sake of getting a degree. I think when you pursue a degree, you want to pursue one with a particular career in mind. And as long as you have a career path in mind, a degree can be incredibly valuable. When you actually take a deep dive into the portfolios of middle income earners and high income earners were 2.5 times more likely to be invested in stocks and growth stocks, whereas middle income earners were more likely to be invested conservatively and keep larger reserves in cash. Now, of course, everyone's risk tolerance is different, but you have to be willing to accept some level of risk if you're going to grow your wealth over time. And if you're aiming to grow your wealth, you're generally going to have to take advantage of stocks. Now, there is a place for both in a portfolio. For your emergency fund or your short-term reserves, yes, keep those in cash-like accounts. However, for those long-term investments, those investments you don't need for 7, 8, 9, 10 plus years, you want to put those in stocks so they have a chance to grow. And once you get this money invested, you want to leave it there. You want to give compound interest the most amount of time possible to grow this money, especially considering that most of these retirement accounts are tax advantaged. Whether they allow for tax-free growth or tax-deferred growth, these dollars and their growth potential is very powerful. Middle-income families were twice as likely to take withdrawals from these accounts or cash out these accounts when they changed employers. And if you're withdrawing from these accounts during your working years, that's absolutely going to reduce their balances over time. The best thing you can do with these accounts and the money in them is just to leave it there, leave it invested. Households with 2 kids had account balances that were 40% lower than households with no kids. And plain and simple, that's because kids are darn expensive. It's reported that the average cost to raise a child is about $300,000. And kids tend to come along in that phase of life where you're already dealing with a whole slew of expenses and the budget is running tight. Maybe you're still paying off your own student loans. Maybe you're paying down a mortgage. Maybe you're just starting your career or you're just gaining some traction. Then you have these kiddos that come along and they come with their whole slew of expenses. No matter how you slice it, having kids is incredibly expensive and can absolutely make it harder for you to save for your future. And finally, marital status matters. Study after study shows that it's easier to build wealth for married couples than for those who are single, especially for those two-income earning households. And this data showed the exact same thing. For those that were listed as separated or divorced, their account balances were significantly lower than those who were married. But what was interesting is that this data found that for those low or middle income earners, they were far more likely to be listed as separated or divorced than high income earners. Going through a divorce can be detrimental to your finances. After years of diligently working and saving and investing, this one act can slice your net worth in half or worse. It's incredibly important to marry the right person and marry someone who has similar financial goals so you can both work together on saving and building a brighter future together. It's more difficult if one person is a saver and then the other person has absolutely no interest in saving for tomorrow. So of course, it's not as easy as saying is get married, it'll solve all your money problems, or marriage is an automatic route to wealth creation. Obviously not. If you marry the wrong person, the person who is not on the same page with you financially, you can end up with far more money problems than you would have ever had on your own. But if you marry the right person, your financial life can be much easier. Keep in mind that life happens. None of these lifestyle factors are set in stone or a make it or break it factor to wealth creation. For instance, you can have kids and build wealth. You can go through a period of unemployment and still build wealth. You can build wealth without a college degree. What matters most is that you're dedicated to your investing and your saving journey and you work at it over an entire lifetime. And I also think it comes down to having an internal locus of control, feeling like you control your life's outcomes. What do you think? Leave your answer in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.